Okay. So let's begin the formal meeting, if we can. Before we do so, just to explain to everyone the mechanics. And again, Mr. Shepherd, correct me if I've got this wrong. I think I got it right last time, but just to make sure. So we're going to stay in this virtual room for the beginning of the meeting, where we'll record apologies for absence, declarations of interest, the minutes. Then I'll ask probably Councillor Wason to second that we move into part B, the confidential part of the meeting, so that we can discuss those matters and really allow our external speakers to do what they need to do before leaving, so they don't have to spend all evening with us. Once that's concluded, we'll leave that virtual meeting, so we will have been in a different link, the one that we were sent, and we'll come back to this part A virtual meeting and carry on with the rest of the agenda. So if there are any people, I can't see them, but if there are any people listening to the meeting, we the committee will leave you temporarily while we talk about confidential matters, and then we'll come back to this link and we'll carry on with the public meeting. So just to make sure everyone's aware, and if you're struggling, let us know in terms of switching. So having said all that, I don't think there are any apologies for absence.
I'm not aware of any, Chairman.
No. Are there any declarations of interest that anyone has? I'm going to assume silence is that you don't. Then moving on to the minutes of the two meetings. So the minutes firstly of the 18th of May. Can I confirm that the minutes are accurate and you're happy with them before we talk about matters arising? Again, I'm going to take silence to be assent. There were various matters arising, just looking at them, some of which have occurred. So credit, thinking about that, we've talked about it. We'll talk about it again later. Passive, we've talked about that, and again, we'll talk about that later. Can't obviously spot lots of other actions, so I think those actions were complete. So again, silence being your assent, I think the minutes of the 18th of May are agreed, both part A and part B. Actually, we'll talk about the part B minutes in part B. Then moving on to the minutes of the 28th of September, so same concepts. If I'll take silence to be your assent. The fire risk document appears in the papers today, so we'll talk about those. That's one of the actions. More detailed ranking on the LGPS fund. This is an action for Mr. Triggs. Where are we on that one?
Apologies, Chairman. What reference in the minutes is there?
So this is A8 on page 4 of the pack, the third paragraph down. It says the chairman asks that the more detailed ranking information be shared with the committee members. This was about the LGPS, the PIRC universe, and how we've done really.
Yes, Chairman, I have asked for that information. I will chase it post haste and circulate results with the minutes.
Wonderful, thank you. And then the next one was Mr. Diaz was going to discuss his proposal further with officers. This was relating to his suggestion that the fund might want to consider having a reference book. Has that occurred?
Yes, Chairman, I did engage with the member on this issue. We have shared information and opinions on the need for such a mechanism for the fund. I would suggest I engage with you offline and explain how far we've got, maybe include the member on that conversation and see where there is to go on it.
Happily. Okay, I think that's a good idea. And then similarly, some of the committee were keen to engage with Adam Street. And you were going to, Mr. Trigg, I think, look to arrange a session with Adam Street. Has that one happened?
That one I've not been able to take forward so far, Chairman.
Okay.
I suggest I do that. Certainly in the run up to Christmas, I can arrange that.
That would be fantastic. As an aside, in other boards and things that I'm on, what we have is a sort of list of actions which goes back, as far as they need to, so that we just keep an eye on some, because some get rolled over, and rather than having to put them back in the minute every single time, it may be easier just to have a list of outstanding actions so that we just remember them. Maybe that's something we could think about for the future.
Noted, Chairman. Yeah, noted.
I think A9, I think there was action, but I think that's been done because it's in the paper. A10 around multi-asset credit, again, I think we can reporting back on that. So I'm going through these. The draft accounts, I think there were various changes. I presume all of those changes were put through, Mr. Triggs.
Yes, all of the suggestions that you came up with at the previous meeting we have incorporated, and that is in the final publication.
Fantastic. I think I also asked for a paper on costs, so we're fully aware of these as a charge. Just reading the minutes, the last sentence in the bit under A14, a paper on costs, so that we were fully aware of what's being charged to the fund. I think that was again one that
we've started work on that, Chairman. It's an exhaustive bit of work that's required, so I would suggest I'll include that on the agenda for the first meeting in the new year.
Fantastic. Good. All right. Good. I think those were all the actions, again, unless anyone spotted some others. I'm going to take silence as assent. Silence, therefore, assent. So those minutes are agreed. Thank you very much. We are now going to move across to part B, but we need to resolve that formally. So, Councillor Wason, can I ask you to second? I propose, but can I ask you to second that we move into part B, please?
I second.
Thank you. Are the committee happy with that? Same thing. I'm going to take your silence as assent. Okay, thank you. So what that means is that we will come out of this session and click on the other link and go into part B. So I'll hopefully see all of you there in a short time. confidential session, but we're now back in the main body of the meeting. Colleagues, therefore, continuing with our agenda, what I propose to do is to go to paper A5 for a decision or a recommendation. So the recommendation is set out in paragraph 2 of the report. Can I seek your agreement that we should follow the recommendation, please? Again, I'm going to take...
Yes, I agree.
Thank you. Thank you. I confirm I support the recommendation. So, officers, I think that recommendation is agreed. Thank you very much. I'm also going to then turn to paper A7, which was for information, and just to confirm that we asked about who'd be responsible for acting on any findings, and CBRE confirmed that they would be. And they also confirmed that they would include an update periodically, I think at least annually, to the committee on how they were executing this policy. And I think also Mr. Triggs mentioned that, I can't remember the full title, maybe he can just help me here. One of our officers with responsibility has also confirmed that this is agreed by him.
Yes, Chairman, that's the head of corporate safety, Ian Kimmett. So he has approved the document.
Thank you very much. So, colleagues, that was for information, so I don't need to trouble you further with an agreement. Thank you. So then, turning back to the main agenda, going to paper A4 on the performance, which again is for noting. The only thing that I was going to flag is when we look at in 6.1 our current asset allocation, clearly the excellent performance by Baillie Gifford means that our allocation to them is up to 24%. I don't know where it is now a couple of months later, probably around the same level. So at some point we probably need to have a conversation around this asset allocation. So maybe at our next meeting we should have a look at where we've got to, both in property, the equity transition, and Baillie Gifford, and make sure that we're not significantly out of line with where we ought to be. I'd also have a question just for an update from Mr. Triggs on the transition process, if he could at some point. But colleagues, does anyone else have any questions or comments on this paper to note? Otherwise, I just ask Mr. Triggs to follow up on the transition point. No? Oh, yes, hold on. Mr. Diaz.
Sure, I was just going to make the same point around rebalancing for Baillie Gifford. Now I wonder if we should consider having rebalancing ranges in place.
We have historically, and I think that's why I think it would be good to remind ourselves what we have said and indeed what actions we want to take. But yes, so I would agree. I'd suggest at our next meeting we look into that in somewhat more detail. Mr. Hobson, you have your hand up. No, Mr. Hobson, are you going to say something, or are you?
Apologies, sorry, Chair. I had mute on, the classic mistake. Just to update on the process for the transition. I had an email that it's due to conclude today, so it's only due to finalise today. So in terms of update on progress, where we are, we're not going to get a full transition report of that at this time. We'll have to bring that. We can either circulate to members or bring it to the next meeting, but we won't have that yet, simply because it's only finished today.
Okay, thank you. So you'll circulate further information, but essentially that's been executed and there's nothing to report so far.
That is correct.
Thank you. Good. Well, colleagues, unless there are any other comments or questions, which I can't see, so let's move on to paper A6, or not paper, item A6, which is a report on the 2 working groups. There's no papers for this, it's just an oral report back. So we had discussions with 3 firms who provide equity tracker funds, and which were BlackRock, Elgin, who we have our funds currently with, and UBS. There were, I think, 3 of us on that call. I took some notes, but I don't want to necessarily lead with mine. So I invite, I think it was Mr. Hubbard and Mr. Davey, wasn't it, who was with me? I'm sorry, I forget. If either of you have anything you wish to throw in to report on what we heard.
I think there's some fairly fine choices between them, but the view I would offer is that UBS was significantly down from the other two in terms of the confidence they gave me in their capability to do hard stuff and the strength of their team. I thought most of the other points, there were marginal differences, a few basis points on fees and things, but they were trivial in the overall assessment of capability.
Yes, I would agree that UBS also seemed to have had a similar problem that Legal & General had when they had a sort of big reorganization into taking on a lot of assets. They'd also been unable to take assets from third parties. So BlackRock probably seemed more professional, but I think the turnover and costs of changing from one provider to another is not worth it. So I think one can believe Legal & General that the issue that the fund had was a one-off and wouldn't recur.
Yeah. So I think quite a lot of the meetings were almost billed as only needing to talk about transition, but we actually went a little broader than that. Clearly, the transition issue with Legal & General was probably the trigger for us to look. But I think, given that we now have a very significant amount of money with LGIM, not having had a look at the sector for a while was perhaps an omission. So I thought we had a good session. I would agree with the others' view. I would have actually said I think BlackRock answered the questions we had in terms of the substance of their answers the best. Whether there was anything they said which was sufficiently so much better that it would actually justify the cost of a move, I'm probably skeptical about. But I think I would certainly think if we were to be allocating even further funds to a tracker provider, then I would think we should think very seriously about including them as an alternative. Just sort of for the record, we asked a whole bunch of questions around their knowledge of the LGPS, how they actually replicated the index, so whether they were actually buying stocks or doing something synthetic, how they worked around index changes we were asking about, their ethical and ESG policies we asked them about, how they represented those, how they lent the underlying stocks that they owned on our behalf, so their lending policies, how they priced the fund, which is important, what happened in terms of when they traded and what if underlying markets were closed, costs we spent quite a lot of time on, and tax treatment. And I would just record my understanding from them, which is slightly different to the paper we had a few meetings ago, was that BlackRock would charge a half a basis point asset management fee and 0.85 of a basis point, so pretty tiny, custody, no license fees, and their lending income would be around 2 basis points. So actually net the sort of fees less the stock lending would be negative, and namely that we would on balance receive funds from them, cash from them, but the direct fee being 1.35 basis points, whereas LGIM, which is our current provider, we're at 2.2. So these are very small numbers, but on very, very big sums of money, they do add up. So our current provider is, I believe, from what they were saying, very slightly more expensive. UBS, for interest, were considerably more expensive in this world, more than double. But that doesn't take into account the bid-offer spread aspect of a switch, or indeed allocating new funds to either of them. Mr. Burton, I think you have your hand up, probably wanting to correct something I've said.
Yes, no, not at all. I was really just agreeing that I think that our advice is, I don't think there's anything sufficiently compelling to make a wholesale switch from, say, LGIM to BlackRock. One of the areas worth kind of drawing out as a distinction between the two is that I think BlackRock are a little bit more greedy in terms of the stock lending. So stock lending is where it's a little learner for passive funds, where you have the facility to lend your stock to another party for in return for a very small fee. And BlackRock keep themselves a share of that fee. They keep 37.5% of the fee themselves for making those arrangements, whereas it's rather less for LGIM. And I suspect that explains some of the fee difference between LGIM and BlackRock, whereas at first glance, BlackRock is lower cost, the half a basis point versus the 0.75 basis points. But I think that quite a bit of that can be explained through the stock lending.
Yeah. I think if we were actually sort of thinking about allocation or reallocation to them, we'd need to go into that in a bit more detail around, because they were making the case that of course they'd say this, wouldn't they, that their stock lending is so much better and they make a bit more and then it all sort of comes out in the wash. But we'd want to understand that a bit more. But I think you make a good point. So anyway, really the upshot, I think, colleagues, is I don't think there's any action that needs to be taken. We did quiz them. We did actually talk about, of course, transition, and we did quiz them quite hard, LGIM in particular, around their transition. And essentially they were saying, oh, well, we were very busy doing something else, so I'm afraid we just couldn't get round to yours. I'm being slightly unfair in characterizing it that way, but that's how I would summarize it. We were saying, well, we don't think that's really an adequate explanation, because fundamentally, if you've got another client who you have to do things for, that's your problem, not ours, and we shouldn't really have to suffer it. So I think they got the message that we weren't super happy with that. As it happened, I believe, Mr. Triggs again can correct me, as it happened, I don't think there were any negative financial consequences to the fund from the delay, but that's just good luck rather than anything else. So had it been the other way around, I think we'd have been pretty fed up if we'd ended up losing money because of their inability to execute our requests. Mr. David, Mr. Hubbard, anything else we wanted to say on this one, reporting back?
I was going to say, you had an interesting point on LGIM's approach to ESG and responsible investment.
Yes, I mean, so LGIM take a very proactive and very public stance on issues, and my question to them was, that's great, but some of these things stray into what I would certainly characterize as political matters. And I mean, we have representatives of two different political parties in the committee, and on some subjects we will disagree. And my concern was that if they're going to take political positions as fiduciaries, I think it's rather different if they're just looking for good governance and making sure CEOs aren't paying themselves too much. But if they're going to take political positions, that's a bit controversial. And should they not at least refer those matters back to the underlying fiduciaries, namely ourselves and our peers? Anyway, that's how they do it, and they're not going to change it just because of us. But I have to say, I don't like that approach. I think it's too aggressive. And potentially, by aggressive, I mean they will take a strong position which may not accord with how we think that they should be holding things. But yeah, I don't think that for me is an issue where I would say we should switch on the back of it. Not unless they started doing something very odd. Good. Shall we move on? So, shall we talk about the credit side as well? Mr. Cook, you were involved in that one, and it's an area that you have some expertise, and you were mentioning it earlier. So, I think Mr. Davey also was there. But do you want to, Mr. Cook, give your thoughts on that?
Yeah, I'm very happy to talk on that. I think the discussion, I think, was really associated. I think that they were talking about various bits of this multi-asset credit selection, but I think they had failed to sort of really answer the question of, what should we be doing other than cash, or rather, should we be doing anything other than cash in the portfolio, and so on. So I think we had a chat with them. We went through that in some detail. I think they've agreed to sort of discuss it more with us further to try and address some of the questions that we asked. There's quite a lot to it, but I think there still needs to be some discussion as to whether, how we can quantify the value to the fund by going into this high yielding asset class, but does it really have enough benefit in correlation versus equities for the yield we're getting? And I think we've still got some work to do on that.
I mean, I think, I'm afraid I can't get my camera to work, but I think in a way there's a sort of misunderstanding that if one had a portfolio with a very large amount of cash and perhaps no other assets, then it would, one of these emerging market debt or the credit high yield bonds, would they be better than cash? Well, yes, because you're going to get a return of 3 to 4% at least, rather than 0 from cash. But I think this is a portfolio overall with 70% in equities, and at the end of the day, these asset classes are somewhat correlated to equities, and emerging markets may not have been in the past, but with globalization are more so now. So then if we've got 70% in equities, then cash at least will hold up if markets sell off, whereas these particular assets will just fall less. So if one had a funding problem, or one thought if equity markets sold off, somebody was going to tell us to liquidate our assets, then there'd be a case for having assets with lower volatility that won't fall so much. But given that the funding position of the council seems secure at the moment anyway, then there shouldn't be anybody who's going to sort of tell us to sell equities after a big downdraft and lock in a large loss. So then the sort of rationale for owning this is less. But I think from their point of view, they were sort of ignoring the rest of the portfolio in their recommendation.
Thank you. So yeah, I think I would concur with the others' view. Just to report back, I think that we do need to think through what we're going to do with the amount of funds that came from the absolute return fund we used to invest in, which is currently parked in cash. And I think we should never be afraid of being in cash. Much better to take our time and think things through and get it right than be panicked into just investing in something for the sake of it. But I think my conclusion was I think there's a lot more decomposition, if that's even a word, of the whole fixed income sector and the various different return drivers within it, and trying to understand which of those, if indeed any, might fit well within our portfolio, and then picking the right solution if one exists, which actually meets our need, rather than just listening to a load of managers who will sell a wonderful story about how brilliant they are, but actually some of what they do might be useful to us and some other aspects less so. So I think we sort of left it with Mercers. I mean, Mercers are with us now too, so they've heard this before, to really go away and maybe take a step back before we can potentially return to this type of investment. So I think, and I would suggest that probably is one that comes to the full committee in whenever we meet, February or something, as a wider discussion on asset allocation. We've talked about asset allocation a minute ago, so I think it would fit in with that quite nicely. So colleagues, are there any questions to any of us, or any other comments, or Mr. Ertlin, do you want to make comments? Officers, any comments? Otherwise, I'm conscious of time. We'll move on.
Yeah, we can pick that up.
Okay, thank you. Good. Okay, so I think that's enough reporting back on that. So we've covered the other agenda items. Is there any other business anyone wants to raise whilst we're still in the formal meeting? No? Okay, well, thank you very much. So the formal meeting is now closed, but